Hello and welcome to Growth and Value Stocks. My name is James Boyd. We welcome you here today on this May 6th. I wore this shirt overnight, and what do you know? Market woke up and the market was green. I don't know if you've realized this, but this shirt has been, well, a pretty good gauge of market forecast. And so if it works, we're going to continue to wear it. So, okay. Some of you are like, I haven't seen that before. Some of you that have been around, you're like, no, that actually has been a pretty good indicator. So anyway, we'll a little fun with that. Now we got Connie Hill with us in the chat. We welcome her. And I also sent out our X handles in the chat. And you're going to see that. You can just click and follow Connie and myself on X. Also, quick reminder that if you have not joined us right on YouTube, just go to YouTube. I mean, who's not on YouTube? Should be the question. Uh, if you go to YouTube and just type in Trader Talk Schwab Coaching Webcast, you'll find our channel there. That channel will actually show us the videos, short videos that we have, playlists that we have, and so on right there. You also want to search for content that we've actually taught. Do not forget the search functionality. Remember, it's free to subscribe, so why wouldn't you subscribe? Now, just real quick, as we get started, this class also has a playlist. So you can get a sense of what we've talked about. You're going to see that on the right-hand side, I sent this list to you right here in the chat. We talked about identifying companies where earnings could accelerate. We talked about our traders focusing on stocks over indexes. Usually, if that's the case, they're trying to, go for those growth areas. By the way, those growth areas, we know they've outpaced value, they've outpaced income. That actually usually happens when the volatility is falling. Trends that could have multiple entry setups. Bearish traders turning bullish again. I'm telling you this because this gives us a sense of what we've talked about over the last 4 weeks. Now, today, as we actually hop right in, as we kind of explain to you some of those tools that you should have and bookmark, with what we talk about, as always, the information I talk about is for general informational purposes only. Schwab does not recommend the use of technical analysis as a sole means of research. Technical analysis is really looking at the study of price and volume. It's interesting. It's definitely not the only thing. And some of these fundamentals could actually coincide with the technicals and so on, sometimes not. But understanding different types of analysis can complement the technical analysis. Technical analysis tends to be the starting point. It's not the ending point. When we show our examples, we will do those on the Paper Money software application. And also remember that investing involves risk, including loss of principal. Now, when we talk about growth, value, and income styles, what are we even talking about? Well, this definition of growth, right? We're looking for capital appreciation. By the way, has that kind of been a focus lately, right? It's not really focusing on intrinsic value or dividends. Value investing, we're talking about, let's say, low price, multiple stocks, P ratios, price sales, things like that. Income, we're looking for companies that are going to give their earnings per share, a big chunk of it, in the form of a dividend. The con there, well, you might not get the growth that some of those other ones are actually focusing on. Now, we will talk more about growth. Now, can anyone, just a quick pop quiz here before we look at charts. If I said what would be a ticker symbol that would, articulate or explain or show what growth is doing in general? Does anybody know a ticker symbol for that? Second question, if I said, is there a ticker symbol that kind of articulates or shows what value is doing? And then third, is there maybe a ticker symbol or two that really shows us what income investing is doing? What are they? Because in three symbols, you get a real idea of what is going on, okay? And if you know those, good for you. If you don't, look at the other symbols that are actually coming in that could really capture what's happening in growth. Now, when we talk about, let's say, first off, the indexes, let's pull up just real quick. I want to start with just real quick the Dow Jones, okay? Now, on Monday, we talked about correlation. How many of you remember that? Now, if you say, no, I don't remember, that hurts my feelings. Say sorry, okay? Now, here's the deal. So when we woke up this morning, we saw some green, okay? Not just on the shirt in the camera, but on the charts, okay? And if we look at, let's say, the Dow Jones. Now, when we're looking at, let's say, the market, and I just want to kind of make sure if we're looking at like having a set routine, what are some of the lists that like maybe the investor should have, because I feel like if we don't like hammer this, then someone's not really following along. Obviously, now here's the thing. When we look at, let's say, the Dow Jones, the SPX, the NDX, okay, the Russell, these are not going to show any movement prior to 9:30 a.m. Eastern. So that's why people look at prices that are showing beforehand. Starts with an F, ends with an S. Not going to go into that. So you can look at a product that's tracking the Dow, the S&P, the Nasdaq, and the Russell. Now, with these, what might be some other good things that we could actually watch right when the market opens? Well, I think a good gauge we could actually look at is the SOX. Now, that's not an index like an equity index, but that has been a key measure for risk-taking behavior. If people are buying the semis, it feels stupid to even ask that question. Have they been buying the semis? Okay, you know the answer. Now, why does that matter? Usually because if the SOX is actually going up, the VIX has actually been staying down or going down. That's another one we would actually put in that list. And the other one we'd actually put in that list is actually the dollar. I can't actually type this in, but we would put in here gold, silver, and copper. Okay. And the last one we would put in here is crude oil. So let me just mention the four: gold, silver, copper, and crude oil. This list that we wrote out, and I said the last four: gold, silver, copper, and oil. Okay, those four: gold, silver, copper, oil. We would actually use the ticker symbols that are going to show the prices. You know what those are because we go over those quite a bit. Now, that list would kind of tell us something. Now, quick reminder, if you're on the East Coast, feel free to actually look at the Dow Jones, the price, look at the S&P price, look at the Nasdaq price, look at the RUT price. That way you can see an indication of if the market were going to open up at that time, approximately where is it? Now, that's not going to say it's going to open there, but that's just where we are at that time. Now, this also gives us an idea of like what sectors to take a look at and go look at. Nasdaq is actually up. Obviously, tech is probably up. We see Nasdaq up and SOX up. Obviously, tech. If we see, let's say, the SOX up, gives us a really good indication that there's probably going to be a growth focus, like tech stocks, communications, discretionaries, and so on. Does that make sense? Okay. A lot of us probably knew that, but some of you are like, I'm glad you went over that. Okay, let me know if someone was glad we went over that. But I just want to make sure I wasn't leaving anyone out there. Now, the one thing you're going to notice really on the Dow Jones, if I were to ask you, like, what type of price pattern do you see on the chart? What would you say? Now, price patterns are never perfect, but I mean, if you kind of look at this, what we've been talking about the last 2, 3, 4 weeks is kind of like the V pattern or like a U pattern. We could also even kind of say maybe like a cup and handle. Now, again, they're never perfect, okay? And if you look at this, a little drop down, and you're going to see like your classic cup here. Now, in the 30 years I've done this, and I said this last week, and I'll say it again, I don't think I've ever seen a time where there's been so many investors get emotionally hijacked off news where they're missing the market rally. Do I have data to prove that? No, specifically people's accounts, absolutely not. But I just get this feeling that people have become emotionally hijacked based upon news. And I've said it before. You can get bad news, and it could be bad news. What I said, and I'll repeat, is that the bad news just lessens. So it's still there. But investors become used to the bad news and just say, carry on. Okay. And that is exactly what we've seen with this whole Iran thing. Okay. Yes, it's still there. Yes, they're probably not going to agree. We know that. Okay. Yes, we know that actually oil has been involved. We get it. But eventually people say, look, I'm just going to go to other things that have potentially movement. And it's still there. Okay. Now, UAE at one point was supposed to go bankrupt, haven't gone bankrupt. Greece, they needed a $5 billion lifeline, else they were going to, the island was going to fall literally into the ocean, never fell into the ocean. And I don't even think they paid the ECB back the $5 billion. Okay. So the moral of the story is bad news can be bad news for a while, but not indefinite typically. Okay. And I could go on and on about that. But the biggest thing is we're not fighting head knowledge. We're all smart people, but the biggest thing is we're fighting habits. We're fighting emotion. And if you don't learn to actually overcome that habit and emotion, that's actually stopping you from riding trends, well, you feel like you're kind of left out because you got emotionally hijacked to habits and emotion. Okay, now we're off that soapbox, but that's very important because I get a feeling a lot of people kind of fell towards those habits and emotion. Now, the big actually thing is when we look at the Dow Jones, I want to kind of point up the one thing we mentioned the other day, which was getting into, let's say, correlation. Well, remember, these are multinational companies. Multinational, they sell here in the US, but they also sell abroad. So I want you to imagine you like Range Rover, and we know Range Rover, they're built in Britain, right? Well, Britain is Range Rover, they're going to price their, let's say, product, let's say in pounds. Well, if all of a sudden the pounds actually go up, we as the US consumer, we got to pay more for the Range Rover and so on. Or if we were going to go on vacation to Switzerland, the Swiss franc goes up. Well, it becomes more expensive. Well, the more expensive it is, the less we maybe want to potentially buy to some degree at some point. Now, the reason I'm bringing this up is if we go to, let's say, studies compare with custom symbol, we're going to bring up the $DXY. And I want you to tell me how you're reading this. Okay. Now, this might just look like, well, James, this is all over the place. Well, that's true. The candle chart is the Dow Jones, and the light, that purple line, what you're now going to notice is that's the US dollar. Now, we're looking at the US dollar, the basket, compared to other currencies, top heavy in the euro. Now, the biggest actually thing is when we take a look at this, we will see recently patterns where when this purple line goes up, what do you notice about the candle chart, which is the US dollar? I'm telling you, if you don't understand this is why the investor is being left in the dust, okay? They don't get it. When you don't get it, you don't trade it. You don't trade it, you don't get it, you don't invest in it, okay? So when that US dollar is actually going up, that kind of looks like there's been a correlation, an inverse correlation, that if the US dollar actually goes up, the Dow Jones has been going down. Now lately, when we actually see the US dollar actually dropping, that purple line chart, you're seeing that the Dow Jones has been going up. Now, if you wanted the Dow Jones to go up, what would you want to see? You'd want to see that purple line drop. Now, can anyone else kind of think of something that's like this? If this purple line goes down, what else could go up? You want to repeat the question? Now, by the way, if you didn't get it this morning, boy, you got exposed quick, okay? If you're someone that likes to trade commodities, gold, silver, copper, oil, things like that, you want that US dollar to actually go down, okay? And if that US dollar goes down, there's some inverse correlation to gold to silver. So think teeter-totter, right? Now remember, we're all in first grade here now, right? We're sitting on one side of the teeter-totter. If it goes down and we're sitting on that other side, where's the other side tend to go up? It tends to go up. So clearly we would say, look, if the US dollar actually goes down, someone might be looking to go long the Dow Jones itself. Stocks in there. Number one, trade something that's trying to track the index. That is number one. I didn't say 10. I said 1. Number two, individual stocks in there that could be going up. Now, what stocks are in there that could be going up? Number 3. Well, the number 3 could be, if we're talking about gold and silver and copper, what sector do those belong to? Well, it belongs to basic materials. So as we dive in now, number one, we could be saying, well, gold with that, silver, copper. What are the ticker symbols for that? What are the ticker symbols for gold, silver, and copper, like individual companies? What's the sector that they belong to? The basic materials. So off one chart, we start getting 4, 5, 6 ideas off what the US dollar is doing and how that's relating to the Dow Jones and how that's relating to commodities. Before you know it, all we did was to look at one chart and we have a bunch of ideas right off the start, okay? So a lot of times we just kind of understand what it's kind of maybe telling us. Now, we'll speak to that here and we'll do some trade examples. So first off, if we came back a week from now and said, my gosh, the Dow Jones is higher, would that surprise maybe you? Maybe not, okay? Definitely showing a cup and handle pattern with a little resistance right around 50,000. SPX, I'm sorry to tell you this, okay? Brand new high, okay? Now, sometimes we as people, we love to ask the question, why? You have kids, right? Are we there yet? Why do I have to take out the trash? Why do I have to clean up my room? We as adults, we still ask why. The simple answer is there's more buyers than sellers. Buyers are controlling that line of control price wise, and they're just knocking the price up. Okay. I'm sorry. I got to be the one to tell you that. Okay. New high again. Now, the one thing we have to say here is when you look at the SPX EW, which was the equal weighted, many investors don't like it when the market goes up and it's a narrow movement. Okay, so they don't like it if tech is the only thing going up, if tech and discretionary is the only thing going up. They think if there's other sectors going up, then they feel better. Look, your spouse doesn't care. Okay, the moral of the story is if the investor benefits, there's not an asterisk on that profit. Okay, if the investor got it, they got it. Okay, whether it was minimal interest of other sectors or lots of it, it was still a potential profit. You get my point? Now, we did see a brand new high in the equal weight, which tells us more sectors becoming involved. Could that actually be a benefit? You decide. Obviously, the NASDAQ actually got more involved here. And by the way, remember what I said. Number one is the investor might consider buying something that tracks the index. Okay? If you'd like to learn more about that, come Friday morning, 9:30 a.m. Eastern. Kevin and I will talk about that. I think a lot of people go back to what they know and they have habits on. If someone says, I just normally buy stocks and the stocks are more volatile, then there's other things to consider in terms of buying something that is a basket of stocks. There's other things out there. You realize that you're falling into habit. Okay. Stocks tend to be more volatile. So you probably need a better level of expertise to maybe trade some of those stocks because they're more volatile. The other thing to also remember is if you're just going tech stocks and discretionary stocks, you're trading the most volatile areas of the market. You might not want that. You might say, look, I want to kind of, per where I am, I might want to kind of trade or invest in things that are not as volatile. So you have to kind of say, where am I in terms of my skill level? Now, the other thing is I'll just say with the Russell, new high. Okay, I'm sorry. I'm not going to say new high anymore. Okay, feel like I've worn those two words out here today. New high. Now, super quick before we look at the examples. Basic materials, your classic flag. Remember, gold, silver, copper, etc. would be in this basket, among other things. We would definitely include steel in that, which people seem to have forgot. Now, if you look at industrials, you're going to see doink to the upside. Things like Kitty Cat, meow, CMI, John Deere, the big green machine. And then you also have some other names like Boeing, etc. Obviously, when we talk about, let's say, the dollars on IXC would be the communications sector. Again, this is going to be Google, which I got a bad feeling people aren't really looking at. Okay, narrow basis maybe, but maybe I think people kind of forgot about that. Google's market cap is higher than NVIDIA's. That's saying something. Okay, we're talking about in the trillions, for crying out loud. Now, if you also look at the one that might be a little surprising, is the real estate. Hi ho, real estate. And if you look at financials, we would not say it's necessarily commercials, but flag, asterisk, it's the regional banks. Okay, so when we look at financials, we're mainly looking at commercials, top heavy, but do not forget about regional banks. That's where we're seeing the strength. The IXY, the discretionaries, of course, that might be getting a little fleeg, little crossover here action. And the one that got pushed down here today was energy. Now, we know it's more tit for tat. One day, the Iranians are actually stuffing the Strait of Hormuz, and the next day, now it's open. So who knows? Maybe tomorrow, something will happen. And that's what's been happening. This has really kind of been like a hedge on volatility in the marketplace. And you know that. We don't need to hit that. Now, I want to kind of go back to a name just real quick. Let's start with just real quick Google, okay? Now, before I go to Google for just a second, I want to see if there's any questions, okay? Are there any questions? Now, Dean actually says Zion. Well, let's just pull this up. Now, Zion is a regional bank here in this area. Well, actually, you know what, Dean? My father's middle name is Dean. So I feel comfortable with that. Let's start with Dean's example. And let's just start here. Okay. I said we're going to hit Google, but Dean, you know what? Dean is He just comes up with some good commentary. So let's start here. Now, if we take a look at this, let's kind of talk about the technicals of it, the fundamental side of it. Okay. Now, if we're talking about something in terms of growth and so on as a value, let's go to the schwab.com website. This is an area that we do not want to be a lightweight in terms of understanding the information that we're seeing. Now, having an understanding of what is it that we're looking for, being able to read it, it's helpful. Okay. And so it gives us some context. Now, what I'm going to do is I'm going to go here. And the reason why I like to look at schwab.com is it really kind of gives us some more information. Now, you could go to on the TOS platform and see some data, but I like to kind of see the comparison. And you'll see this in just a second, okay? If we scroll down a little bit, what I'm really trying to look in for is, number one, is there a dividend? Now, if they're paying, let's say, an annual dividend of, let's say, 2.85, I mean, it's not massive, but sometimes you don't want it to be massive. You want to see the company actually keep some of the earnings in the form of savings and potential future investment. Now, the big actually thing is, what's the dividend payment been doing over time? Number two is we actually see, now, by the way, I want to kind of make mention of something, okay? If you were to, let's say, look at a fixed income, and people look at the dividend and they compare it to a fixed income. If you went out, let's say a year, though, in a year, they're at 3.85-ish, 3.83 as of this morning. That dividend is about 1% or 100 basis points less than what that 1 year rate is. Now, that's kind of important for people to kind of gauge the difference. If we look at the earnings, it's kind of been more flat-ish, okay? If we look at historical earnings, they've actually beat 4 out of 4 times, okay? The forward PE, and this is what's kind of interesting, okay? The price to earnings trailing 12 months, the PE ratio is 9.78, okay? This is what's so funny. This is why I do this, okay? Everything is overvalued. Yeah, right. You haven't even looked, okay? You could fake some of that. You ain't going to fake us, okay? You didn't look, okay? So when you look at the PE ratio, 9.78. Now, some of these companies don't trade with a high trailing PE. The forward PE is higher than the trailing. So that actually tells us the earnings per share is decreasing slightly, not massively, slightly. Usually that forward PE is actually going to be a higher because the earnings per share going forward is higher. Now, the biggest actually normally, if we take a look at the PEG ratio, you're going to see it's only 1.64. If you had a PEG ratio of 1, that's pretty phenomenal, okay? So you can't really say that this is, oh yeah, it really overvalued, okay? Now, if you go to the PE, this is where it gets interesting. So not only do we see Zions, and it's comparing it to other regionals, now we could kind of see things like the EPS growth forecast. We see things like the net profit margin, and you get into some of this where we can also see information like balance sheet, income statement, etc. This matters because it can influence the valuation of the company that pushes up the prices, okay? Now, if I actually pull this back up and let's just take a quick peek. Now, remember, when investors looking to get in, they're probably saying, is there an upward trend? We start with a 1-year daily chart. And if we're starting at the lower left-hand side on the left hand and we're over here on the right-hand side, that's an uptrend. There's an incline to the upside. Now, what is the most recent support? I said yesterday, okay? When we look at the most recent support, we're going to go back about the last, let's say, 2 weeks at a time and say, show me that potential support area. Right around 61 and change, right around 62. Now, I'm going to tell you right now, one of the things that many investors learn is do not set stops too tight, okay? And I'm going to kind of show you what we mean by this, and I'm going to show it on a numerical basis, okay? Now, a lot of people, when they're getting started, they'll say, look, okay, now, by the way, when we look at this, we see a support. Do we see an entry? Well, we see on the chart that's a close above the high of the low day. That's what we call a bullish bounce. If we went to the next chart in, we would actually see 3 lines. The orange line really represents a shorter term breakout at 10-day high, which we're hitting today. The blue line is a 20-day high, which we are hitting today. So if you said, I'm looking for breakouts based upon a duration of time, this plots the 10-day high over time. The blue line plots the 20-day high over time. And that kind of gray line plots
the 55-day high. Why is there a difference? Well, because if we have 356 people with us and watching, not all of us are the same. Okay? So some people like to get in on a shorter term duration. They're more short term. They're more intermediate, maybe on a 20-day high. And someone says, I'm more intermediate longer term. Irregardless, whoever we are, it's hitting all three of those lines. Now, does that guarantee that it's going up? No, it's just showing an entry point. Okay. Now, what I'm going to do is on this is I'm going to right click on the chart. Okay. And what we're going to now do is right click, buy custom, and we're going to go with OCO bracket. Okay. Now, first off, when we look at this number, just really quick, and I want to bring up something right here, new sheet. Okay. So if I bring this up and just, we're going to quickly run these numbers. Okay. Entry. Okay. Support. I'm going to say stop. And let's just start here. Okay. Now, when we look at this, what's the entry? 64.60. Okay. Where do we see support? Well, I'm going to put it right at 61.27. 61.27. Where's the stop? Well, if it's over 50 bucks, we're going to take that support less 2%. And now we have a stop at, let's say, 60.04. You know exactly where we're going. What's the risk per share? Okay. Well, the risk per share would be 64.60 less the stop. And if we look at that, it's going to be $4.55. Now, is everyone with me? Everyone with me? Now, if you're someone that says, look, James, I like to check the ATR, check it. Okay? Feel free to do that. I'm not going to do that for this time's sake, but you could put that right there. Now, the reason why I like to look at that 456, I want to know what percent, if we lose 456 of the entry price, what percent is it? Okay? Now, I'm going to write this down so we can all follow along. So what I'm doing is I'm taking the risk per share divided by the entry price. Okay? Now, what does that percent tell us? I'm going to tell you right now, if that percent was 2 to 3%, very tight stop. High chance of being stopped out. Now, that might be fine if you want to, or if you're saying, I'm trying to get out. But if you set a percent, if you had a percent of 2 to 3%, it's like you're choking the stock and you're not even allowing the stock to inhale price up, inhale price back to make a higher low and or test support. You're doing it to yourself. Okay. Now, if that number was 3 to 5%, this is even still like, I'm going to say this is like medium. This is really, and I literally mean 3 to 5%. This is medium. This is still a pretty tight, okay, stop loss. Okay. Okay. And if it got like where you could say, okay, now I'm giving it some room, this would be kind of more normal, 7 to 8% more realistic. Okay. If you want to say that word, more realistic. And if you're saying, James, I'm giving 8 to 10%, you're allowing for price fluctuation. You're trying to say, look, if it pulls back, I'm trying to allow the pullback to happen to create the base of support. Now, why do I bring this up? Well, because if you ask most people about their first learning lessons of stocks, they choke, okay, the stops. And all they do is they just prove what I just said. Now, James, did you ever have that experience? Of course I did, okay? I wish somebody would explain this to me. There was no one there to explain that to me, okay? So when I look at this, where are we at percentage-wise? We're at 7%. What does that tell us? It's a more realistic. We're not choking the price, the stop, if you will. We're trying to allow that stock to have movement. Where's the stop on the price? A chart. Well, we're at 60.04. So if I bring this up 60.04, and I'll show you this where this is on the chart, you're now going to see that 60.04 is right here. Okay? 60.04 is about right there. Are you with me? I'm telling you, if you're not paying attention right now, the lack of you not paying attention, you're going to pay for this. Okay? If you just say, I like pain, then don't listen to what I'm saying. The problem with stops is when you get stopped out, it locks the loss in. And sometimes when it locks the loss in, the stock could have never even broken support. You get stopped in, you lock in the loss, potentially, if it is a loss, then the stock bounces, it goes to the upside, and now you feel like no one knows how I feel. Okay? And there's another example where I got stopped out only to see the stock shoot to the upside. There is nothing more painful than what I'm talking about. Okay, now, if we're talking about, let's say, areas of resistance, okay? Now, by the way, if we look at the area of resistance, many investors, given kind of what the market sectors and stocks are doing, many investors are probably using good old Fibonacci. Now that Fibonacci, if we say, where's the area of resistance? The 161 is 66. The 200 is the channel width added on top of resistance. It's at 69. I'm going to put the Target right at 69 and change. Could it be higher? It could. Now, if we look at this, where's the 261? It's at the 74. Okay? Now, what I'm going to do in this case is I'll just go confirm and send. We're going to set this up. So this is saying, look, buy the shares at 60, 64, 62 or lower, target at that price or higher, and then we're saying sell it if it goes to that price or less. Okay? So why do you say that 3 times? That's the risk of the stop. It could be filled at a lower price. So that's why you are annoying. That's sometimes why I am annoying. Because if someone says to me, I didn't know the stop could be filled at a lower level, that's why I was trying to be annoying to get your attention. At least I know I was being annoying. Okay. Now here's the deal. We'll go ahead and confirm and send that. Now, here's the deal. I want to go back to one of the examples. I said we're going to talk about Google. We will. Okay. I'm going to go back to Apple for just a second. And what I want to do here is I want to just do a couple examples in less than 15 minutes of running the numbers, okay? And I'm going to show you what I mean by this. As a matter of fact, with this, I'm even going to bring up ATR. Some of you love that. You're like, look, I love to see that because, James, I like to set tight stops. Well, the paper money account doesn't. But it will show this. Now, what does the ATR have to do with growth and value stocks? Well, trading growth and value stocks. Well, when you talk about trading growth and value stocks, the biggest actually thing you need to recognize is that's going to give us, think of this as that ATR 13.24. That's the price fluctuation from low to high on average over the last 14 days. So if we got in at, let's say, 284 and set a stop at 280 and said, my gosh, I can't believe I got stopped out and locked in the loss, we would say, yeah, no kidding. So that means that on this, that when we look at the risk per share, it better not be less than $13. Because if it is, all we're doing is we're doing it to ourselves, meaning that we're just getting stopped out with the information in front of our face, but we're not understanding what it means. So with that, okay, I'm going to go back to this chart. And remember, some of these investors might be thinking Apple might be trying to break out to the upside. Now let's run the numbers. Remember what I said before. Investing is math, psychology, and strategy. Okay? So if we come back to this, we're going to pull it up. Let's run those numbers. Here we go. So if we look at that, we got, let's say, 285.03. Where do we see the support level? Now, notice I kept saying, and I've said this a couple times in the last 24 hours even, we're not looking to see where the support is over the last 2 to 3 days. I never said that. I said go back about the last 2 weeks. Well, if we looked and said, where's the support of the last 2 weeks? And this could be the problem of where the investors are doing it to themselves, getting stopped out left, right, all over the place. Well, we had a breakout there. Have we pulled back to retest that? We did yesterday. The tightest we could set the stop is 274.47. If we wanted to set a little bit looser stop, 266 and change, 267. And if we took the midsection, we'd probably take about that area. So if you said, look, what is the tightest we would set it? 274 and change. If we did that, let's run those numbers and double check. 274.47. Now, remember I kind of talked about that ATR really being about 13. Now, by the way, that was the ATR on that weekly chart. The ATR on the daily chart is 657. So what is this actually telling us? Well, and I'll show this. This right here, let me actually close that. Okay, the risk per share is at 1605. Getting in here, setting a stop there. The risk per share, 1605. Well, the 1605, how does that relate to the ATR? We're setting the stop is 2.44 times the ATR, which means if we had a bad day down of $8, probably going to still be in the position. If it goes down, let's say 2 times the ATR, there's still a good chance we could be in the position. You go down 3 times the ATR, probably not going to be in the position. Okay. Now, some people might say, James, that 274 seems a little tight. I want to give it a little bit more breathing room. Now, what does this really do? When you, for example, set a stop, when you give it more breathing room, what does it do to the number of shares? What does it do to the number of shares? It pushes down the number of shares. When it pushes down the number of shares, what does it do to the unrealized gains or losses? It pushes them down as well. So many investors who have experience would say, look, I'd rather give it a more forgiving support level and set a lower stop and take more price fluctuation. Now we know, I don't need to tell you this, we've been in a market where the volatility has been higher. And the volatility has been higher and the investor understands that. They wouldn't be setting tighter stop losses if they understood that. They'd be setting looser stop losses. Why? Because they're trying to let the stock fluctuate. Okay? They set a looser stop, they buy lesser shares. They buy lesser shares, they set looser stops, there's lesser chance of getting stomped out. Lesser chance of getting stomped out, lesser chance of getting realized losses. What does that do? It gives them a better chance to ride that trend. Okay? Now, we pull this up. We're going to set the stop at 265.65. There. Okay? Got to bring up on that Apple. Okay? That price, we're like, wait, that price don't look right. And now what we're going to see is 265. Okay? 65. 265. Double check. 65. Now, I'm going over this because I've had a bad feeling lately, okay? Dated GTC, dated GTC. Now, remember, when you have consolidations where you break out, you're thinking channel width extension. When you have cup and handles, U's, V's, all the above, you're thinking, oh, Fibonacci, okay, probably to see where that extension is. If I said I didn't even know how to spell Fibonacci, which I don't, okay, I could try. But if I don't know anything about Fibonacci, now all I know is in Technical Analysis 101, they taught us channel width. Well, channel width, first lesson in technical analysis, if it breaks out of a sideways channel, range-bound movement, the path of least resistance is it might try to cover the width of the channel being $33. We take the $33, we add on top of resistance. That's in the first lesson of technical analysis, if we do not fall asleep, okay? Literally would be right here. Now, do we know it's going to go to there? Well, you might know, but I don't, okay? That target is really going to be about 312, okay? Now, with what I've gone over so far, I want to challenge you. When you're setting up your trades, I want you to go through the math, okay? I want you to look at the risk per share. Now remember, the risk per share is in a dollar amount, okay? It's in a dollar amount. When we look at the risk per share, we're thinking, well, what does the $19 mean to me? Well, $19 means to me, if we bought it at the entry price, we want to look at the percentages. That percentage is telling something us about the strategy. And then the strategy tells us something about the likelihood. Are you picking up what I'm laying down? Okay. So now what I'm going to do is we got the target. We're going to put that 312 there. So trade number 2, 312. We got to stop at 265. Now, a lot of people would say, yeah, but I don't like to set the stop that low. They miss the discussion on this. So when we look at this and say, okay, the percentage is 6.8, what does it tell us? Well, we're kind of more closer to realistic. What does realistic even means? This probably means that we're outside 2 times the ATR. That's what it means. Now, if we said, James, yeah, I'm going to use that 5-day moving average and I'm going to set a stop right at 280 because I'm a trader. Okay, fine. If you said that, if you set a stop at 280 less 2%, it's going to give you $10. Well, what is $10 relative to the entry price? It's 3.73. And it means if you have a bad day, you cannot take more than 2 times. We're at 1.6 times the ATR. That means if we had here's the thing. Do you realize what you've just done to yourself? If this stock runs to the upside, which is not unusual, and if it has 1 down day, 2 down day, and if you said back to me, I love flags. No, you don't. You don't love flags. Because if you love flags, then why in the world are you setting a stop not even at 2 times the ATR? Because if this goes down for 1 down day, let's say it's 1 ATR, then it goes down for the 2nd day, you can't even handle the flag. You talk about the bull flag, but you can't ride that pullback out. And so this is why it seems like you can never capture higher highs, higher lows, higher highs. The only way your methodology works is it just goes straight up. Now, can that happen? Yeah, percent. And then when it goes down for 1 or 2 days, you cannot ride momentum, that's sad. And then all of a sudden you get stomped out only to see the stock go doink. Stock goes down 1, 2, 3 days. You get stomped out, doink. And you always feel like all you're doing is getting in, getting out, getting in, getting out, getting in, getting out. And you're never riding the trend or momentum. Who did it to you? Yourself. Okay? So number 1, as people, we tend to listen to what you want to listen to. Lesson number 1 here, tough. What some people do is they buy a group of stocks because it's trying to minimize the fluctuation. Number 2, if someone buys individual stocks and they fully understand what they're doing, we don't set stops 2 to 3 days like where the support was over the last 2 or 3 days. It's over the last 2 weeks so we can handle that price fluctuation. If we do that, it's going to give us where the stop is lower. It's going to push down the number of shares we actually buy, which is less capital. And then we could take the volatility, better chance of it. And then what that will actually do is it's going to increase the risk per share. When we increase the risk per share, it's going to lessen the number of shares we buy. So now we're not as emotionally hijacked to price fluctuation. How do you know that? I knew a guy, okay? And now what it will do is, now when we have these flags, we have a greater chance to ride those out, okay? So even if the stock ran up and pulled back, be very careful about adjusting your stops up too much, okay? Now, James, as you say that, it sounds like you're talking out of both sides of your mouth. Not really. Because if you went back to, for example, what I have shown, and I'll re-show again, remember when we talk about setting the stops off an 8-day low, how long is an 8-day low? It's about 2 weeks. How long is a 10-day low? That's right at 2 weeks. So what you're now going to notice is if someone is setting stops off a moving average, their stop is going to be really tight, and we could see that. The white line is the 8-day low, and the red line is the 10-day low. Notice where those stops would be. It would be down here, down at 265. Where someone that's setting tighter stops, they would probably be right around 270, which means they're not giving a whole lot of fluctuation for it to trend, okay? I went over this today because if you're not crystal clear, this is concrete for you. Position size we talked about today, and then giving the stocks some range of movement, all you're going to do is just prove that the math that we've talked about here today is just exposing your strategy. Now, some of it might be on purpose. Sometimes that's not maybe what you intended, okay? And so I wanted to take the time to go over this. So we did 2 trades here today. What I want you to do as far as a homework assignment, I want you to go back and historically, but also as you do some new trades, go through the math. And I want you to be able to tell me how tight are your stops. I want to know what the percentage is there, and I want to know what the ATR is. When you look at the risk per share, what's that multiple of the ATR that you're taking? Rewatch this class again. It's been recorded. I'm out of my time here today with what we talked about. Remember, we talked about kind of growth. If we see the VIX flat to down, growth will probably have a focus, and that's really what we've been still seeing. Also remember about correlation. You could take one chart and really come to 4 or 5 trade ideas based on that one chart. And it's surely enlightening when you actually start to see that. Remember, with what we discussed, it was done for example, illustrative purposes only, talking about trading growth and value stocks with a real big focus on setting realistic stops where they have greater chance to maybe try to let the trend. With that said, stay tuned for our next webcast coming up next. Thanks to all of you. Thanks to Connie as well. Stay tuned for our next class coming up next. Bye-bye.